US inflation has been stubbornly high, and that has been one of the motivating factors for weakness in the market over the past couple of weeks. The question is, will inflation crash the stock market even further? I'll answer that question, show you some things to look at to determine when the market might turn around. Plus, I will do my normal analysis of the markets, the commodities, gold and oil, currencies, Bitcoin, and then finally look at the day trade of the week on ACON. So the stock market tends to focus on two things at any one time. And right now, the number one thing is inflation and therefore interest rates, stubbornly high interest rates. And then the other is earnings. And we, of course, are in earnings season, which has led to a number of stocks making big moves up or down. But let's focus on inflation. The key here is that because it remains higher than liked by the US Federal Reserve, we don't have a sense yet from the bond market that interest rates are going to be lowered anytime soon. The hope at the start of the year was that interest rates would get lowered 4 times this year, and that led to a pretty good rally from November into December. Well, since then, the market has sort of languished, and that's because these inflation numbers keep coming out that remain somewhat elevated. And so I think there's two things that we can do. We can try to listen to the news and figure out what inflation is, or we can listen to what people are doing with their money. I prefer to do the latter. I don't think I'm smarter than the millions of people that trade the stock market. And so I just would like to look at the charts of some of the key market indexes that affect or indicate the market's impression of inflation. And the two primary ones are the bond market, we'll look at that in a moment, and then of course gold, which has been quite strong through this stubbornly high inflation situation that we're in. So let's jump in and take a look at those. Of course, investors want to see this inflation get under control because it will indicate that interest rates can start to drop. So the first chart we're going to look at here is that of gold. And you can see that gold has been moving higher over the last 8 weeks or so as thoughts that interest rates would be lowered really haven't materialized. As long as this chart is going up, I think you've got a pretty good indication that inflation is relatively strong. And so if we start to see this break down, build some falling tops, then that's one sign that interest rates may start to drop, which would be supportive for stocks. Now the other, and I would say the more important chart to watch, is of US Treasuries. This is the TLT, which represents 20-year Treasuries. And if this is going down, as it has been, then interest rates are rising in the bond market. Now the bond market tends to predict what the US Fed will do. And so usually it will start to move up, the bond market will start to move up before the Fed drops interest rates. And so what we want to watch for is if this chart breaks this downward trend line that I have here in red. So right now we have the potential for a rising bottom, and typically bottoms are made in a market when there's a break of a downward trend line from a rising bottom. So we would have to see the bond market move up, get through this $95 level on the TLT, assuming that we hold this rising bottom that's formed right here. You can see that we tried to do that in 2023. We were building these rising bottoms, but we could just never make that strong break. Then we had the Santa Claus rally, which took an oversold bond market up to the trend line where it got stuck. In other words, the market didn't get the proof that it needed to break the downward trend line. So watch this chart. This is the most important to watch. If we can get a break of the downward trend line on the 3-year weekly chart, we may see interest rates then start to come down, and that'll be supportive for the broader market of stocks. Now you can get these charts on Stockscores.com, my website, and of course, make sure you're subscribed to the channel because I do this analysis for you every week, and I will always keep you updated on this and other indexes. All right, let's take a look at the overall market now. I'm going to jump into the Stockscores website. And here we have a chart of the S&P 500 first. You can see the weakness through the month of April. This week we had a little bit of a bounce back. It's not really overcoming the pessimism just yet. It's right at that downward trend line in the short term. Looking at the 1 month chart, that gets a little more clear. Here is the downward trend line and we're sort of right at it. We maybe closed slightly above it on Friday, but I don't think we've got a conclusive break of that downward trend. We were quite oversold last week. Stocks bounced back, but they're not really out of the woods yet. Let's look at the NASDAQ market, where a lot of that weakness happened as stocks like Nvidia and then weak earnings from Meta took this market down. And if we go to the short-term chart, you can see again the downward trend line roughly like that. So we're below it. We went oversold. Anytime you're far below the trend line, you're oversold. And we've bounced back to it. So we're now not oversold, but we are still in a negative market. We need this downward trend line to be broken, given that we've built this rising bottom. That's something to watch for next week, but I'm not going to be too enthusiastic until I actually see it. Now the Russell 2000 fared a little bit better. This is the small cap market. And here we have the downward trend line, and we've maybe made that break through it from a rising bottom, but without the participation of the S&P, I'm not too enthusiastic just yet. I think it's a good step in the right direction. And what's good about this market index is that it tends to be a little bit more interest rate sensitive. The small cap stocks are more sensitive to interest rate direction. And so if we see this market start to lead to the upside, that may be one signal that the bond market is going to improve and thus interest rates come down. Not quite there yet, but getting closer, so we'll watch that. Now the Canadian market has a pretty different chart, and the reason is that it has a heavy weighting of commodity stocks, particularly mining and energy stocks. There's the downward trend line, and we're just knocking on the door, having built a rising bottom. It didn't fall as much as the S&P, and again, that's because of the heavy weighting of the commodity stocks. This market was expected to stall here because it rallied very nicely up to resistance, where it got stuck back in 2022 before interest rates started to be raised. And it's made a nice comeback all the way to those old highs. It got stuck there. I think we probably bounce back in the near term and go sideways here. And then as interest rate outlook gets better, we should see a breakout to new highs. So relatively neutral market right now. Let's take a look at the commodities that really are important to the TSX, gold and oil. And you can see on gold, we are in a upward trend on the daily. We had some weakness early in the week, pulled it back to the upward trend line. It held, and let's watch and see if it continues higher, or do we build a falling top and break down through the trend line? If this happens, that's a negative. And if we get through these highs after bouncing off of the trend line, that is a positive. How about oil? USO is one of the ETFs that tracks oil. And there on the daily time frame, we can see that we have an upward trend. If we go to the intraday time frame, it's a little bit choppier. We've had, a few weeks of sort of sideways trading as a lot of these stocks take a little bit of a breather after having some good gains. And that's expected because oil rallied up to resistance at this old price peak. So anytime a market rallies into resistance, it usually gets stuck at resistance, and it could go sideways here for a bit and then break out, at which point the next level of resistance is up here. I would say the market for oil is generally optimistic, but quite volatile. And so it's a little bit harder to trade because there is that volatility which can whipsaw you out of positions. All right, let's take a look at the US dollar, which is heavily affected or heavily affects commodity prices. And yet, despite the rising US dollar, we've seen those commodities go up. So in global terms, things like gold and oil are even more expensive because the US dollar is higher relative to other currencies. What used to cost you $1,000 in US dollars is now going to be higher if you're buying it in yen or Canadian dollars or euros, that sort of thing. So the US dollar is strong, making everything more expensive globally. I want to jump into Bitcoin now. It obviously has had a great run to the upside. It went parabolic. So anytime a trend goes parabolic, it's usually topping, and we've seen this topping cycle here over the last 6 or 7 weeks. It's not breaking the upward trend yet, so it's not really dead or particularly bad. It's just it was in need of a little rest. And I think we're going to work our way back to this upward trend line. And then the question is, do we bounce off of it or do we break it? I don't know the answer yet because we haven't tested it yet. But for now, I think it's neutral in the short term, and therefore a little bit of caution warranted because we could drift lower again down to this level. The long-term picture is still okay because the momentum is up, but it is taking a bit of a break right here. And then finally, that bond market chart, we'll just revisit that. Here is the daily chart. I'm going to draw the trend line like that. And you can see that we're quite far below the trend line, as we were here, and then price ran up to the trend line. And so it's likely in the near term that we're going to see this run up to the trend line, which would mean interest rates drop, and that would be supportive for stocks, particularly small cap stocks. Now remember, I said earlier in the video that the small cap market is slowly getting better, and therefore it may be telegraphing an expectation that the bond market is going to make a little bit of a comeback next week. So we'll watch for that. What you want to look for is if I go to a 1-month chart, so now we've got hourly, or this is actually a 2-hour chart. If I draw a trend line like this, if we start to break that 2-hour trend line and start to move up, then I think you'll see a little bit of an improvement in the stock market, particularly the small caps. And of course, you can get these charts at Stockscores. They're free. You just punch in the symbol, and then you can use these links at the top to quickly change time frames. So if I wanted to look at a 60-minute chart, just click on 60-minute, 30-minute. It's very quick and easy. And if I wanted to go 3-year weekly, there it is, real fast and easy to check multiple time frames, which I think is so important for the analysis of the market. So my ratings, raised my ratings on US large cap and small cap stocks to neutral in the short term, still bearish for NASDAQ, and that's because some of those earnings numbers were a little sketchy for companies like Meta, and then you had the weakness in NVIDIA, but then you also had some decent performance for Microsoft and Google. So it's a bit of a mixed bag on the NASDAQ. Canadian market neutral on both time frames. Gold remains bullish on both time frames. Oil neutral, US dollar bullish. Bitcoin neutral on both time frames, and bonds still negative, bearish, but we are oversold, so I do think there's a good chance that we'll see the market snap back. So now I want to take a look at the trade of the week. This is an example of a stock that we traded in the Active Live webinar, which we run every day at Stockscores.com. You can learn more about that at Stockscores.com. For active trader members of the website, you can participate in this, and we're just running real-time algorithmic analytics on the entire US stock market, looking for stocks that are abnormal, and then we have different strategies to trade them. My favorite strategy these days is something I call an early riser. You'll see here a little blue dot on this chart, and that's the first signal for an early riser. Now we want to take the first one after a pullback, so the stock makes a move up, makes a pullback, and then makes the old blue dot there. So that's our entry point. On this particular stock, it was right around 35 and a half cents, and it went for a nice run through the day. It actually almost doubled as the day wore on. Our sell signal on this trade was right in here for about 6 times risk. So what that means is if you risked $1,000 on this trade, it had a $6,000 profit. If you didn't want to risk 1,000, maybe you only want to risk 100, then your profit's $600. And we can learn more about how I do all of this stuff, the indicators, the method, position sizing, risk management, when to buy, when to sell. That's all covered in the education that we do at Stockscores.com. Give that a look. Make sure you're subscribed to the channel. Click on the like button. It always helps the stock or the video rather get picked up by the YouTube algorithm. So I appreciate it if you do that for me. Hope you've enjoyed this week's analysis, and trade well.